Hello and welcome to episode 43 of the Special Situations Report, a podcast by Inside Arbitrage covering the most intriguing event-driven activity over the past week. My name is Asif Suria and I'm coming to you from the beautiful San Francisco Bay Area.
And my name is Tamanna Suria, and I currently attend the University of California, Los Angeles.
What we will cover today on the podcast is just a small part of what happened in the Special Situations world last week. For daily updates and alerts, as well as access to tools to help you identify opportunities such as our merger arbitrage tool, check out insidearbitrage.com. Please take a moment to like and subscribe to this podcast on whatever platform you may be listening on.
We are continuing with our new format by focusing on 4 key stories, including a potential deal for the satellite connectivity company Globalstar, the battle between Pfizer and Novo Nordisk for the obesity drug company Metsera, an M&A deal with an embedded spinoff that reminds us a lot of Pfizer's acquisition of Biohaven, and a large buyback at the gas station operator Murphy USA. Before we begin, we want to state that nothing on this podcast is meant as investment advice, and please refer to our full disclaimer at the end of the podcast for more details.
I know we said 4 key stories, but I think we've woven in a few mini stories in the middle as well.
Absolutely. And we'll kick off the first of these stories with a look at deals in the works. At the very start of this year, we came across a series of insider purchases at the mobile satellite communications company Globalstar by the executive chairman. The company provides voice and data communication services as well as wholesale capacity services through its global satellite network. Globalstar primarily provides reliable connectivity in areas not served or underserved by terrestrial wireless and wireline networks, and in circumstances where these networks are not operational due to natural or man-made disasters. The company also has a number of other spectrum-based services, including a developing Internet of Things data transmissions business that has a number of unique applications, including some of my favorite and most amusing use cases in the world: horse tracking via an app called Spotter, and sheep tracking via Find My Sheep.
I know you found that quite amusing when you were writing about Globalstar. The Find My Sheep kept coming up over and over again. And the company's done quite well since then, despite the Find My Sheep app.
I mean, maybe it's because of the Find My Sheep app. But no, it's actually due to a partnership with Apple, which we'll dive into shortly. So we wrote about the company twice in 2 different Insider Weekends articles. We actually ended up adding it to our model portfolio for a couple of reasons. Firstly, Globalstar had a landmark partnership with Apple starting in September 2022, where Apple announced that it had partnered with the company to allow users to send emergency messages from remote locations using Globalstar's satellite network. Apple had initially allocated $450 million to support the feature, with Globalstar receiving a majority of that funding. In return, Globalstar agreed to allocate 85% of its network capacity for future Apple services. In November 2024, that partnership was expanded, with Apple agreeing to invest $1.5 billion to fund a new constellation for expanded satellite services. $1.1 billion of the funding was allocated to actually constructing the new satellite constellation, while $400 million was exchanged for a 20% equity stake in a special purpose entity owned by Globalstar that will manage the constellation.
That's a lot of money that Apple was putting into this company and quite a huge capital contribution by Apple. Was there anything more as part of this deal?
Yeah, so Apple continued to funnel money into Globalstar through this agreement, agreeing to pay $232 million that Globalstar intended to use to pay down debt. Now, at the time that we wrote the article, Globalstar had about $330 million of net debt and a market cap of around $4 billion, which means there wasn't a lot of leverage to begin with, so that $232 million was quite significant. Furthermore, Apple was willing to bankroll CapEx for Globalstar, reimbursing the company for 95% of all approved capital expenditures Globalstar would make in connection with the new satellites.
So all of that was wonderful. And I remember when we wrote about it, that piece was super exciting. A company that was going to get deleveraged, a lot of its bandwidth was going to be used by Apple. But what about customer concentration risk, right? Because there's one customer, not taking into account Find My Sheep. You had this one customer that was going to use up all their bandwidth, if you will.
So, customer concentration was certainly a concern, but consider that Globalstar was essentially getting reimbursed to update their satellite network, enabling them to partner with other companies if they wished, with a guaranteed customer and revenue at the end of it all. The new deal with Apple was expected to more than double revenue once the satellite systems became operational. And that too, Apple is a giant in the sense that they aren't going to spontaneously combust in the next day. So, yes, customer concentration was a concern, but it wasn't necessarily due to the risk of who the customer was.
Yeah, but often in investors' minds, the customer concentration risk has to do with, the customer deciding to pull the plug on a project and moving on, much like what Apple did when it was considering launching its own TV. And I think they had a supplier to develop Sapphire-based display systems, and they ended up pulling out of that project, and the supplier ended up going bankrupt.
And that's a very valid concern. And Globalstar did see its stock decline due to the misreported news that Apple had partnered with one of their competitors, Starlink, to start offering the same satellite communication services. However, a closer look at that statement revealed that it was actually T-Mobile partnering with Starlink, and it included both Apple iPhones and Samsung Galaxy devices. But that program is still very much in beta form. However, this is quite a significant project for Apple to undertake on its own, which is why partnering with Globalstar makes a lot more sense to launch these satellites basically into orbit, and therefore the risk of Apple pulling out if they wanted to still keep this same communications infrastructure and capabilities also seemed a little bit low. And then the other part of our thesis at the end of the day were smaller partnerships with companies such as Piker Holding and Parson Corporations, as well as an uplisting from the NYC American to NASDAQ and a reverse stock split for Globalstar in order to improve marketability and liquidity. So there were a couple other factors at play beyond Apple just funding and becoming a major customer for Globalstar.
Indeed, and the market eventually recognized this, and the stock is up 156% since we added it to the model portfolio.
Right, and that brings us to present day. So why are we talking about Globalstar again? Well, Bloomberg reported this week that the company is working with an investment bank to explore a potential sale and has actually held early talks with Elon Musk's SpaceX, among with other potential suitors. Now, the company hasn't made a final decision on pursuing a sale and could opt to remain independent. That too, Apple will likely have a say in Globalstar's future, giving their existing partnership and their 20% stake in the company as part of the deals that we talked about earlier. However, it's interesting to see this play out, and if the company gets acquired, we've already made a nice 156% return, so that'll be a nice little added bonus.
Indeed, it would be. Switching gears from rumored deals to a current deal, we have discussed numerous times before that nearly 95% of announced M&A transactions are completed, and sometimes with higher offers after a bidding war breaks out. Even during a year like 2020, which was impacted by the global COVID-19 pandemic, we saw 90% of announced deals close. In that context, it was interesting to see two deals fail back to back, and both because of shareholder opposition. The TaskUs deal failed earlier in October after minority shareholders held out for a higher price, which unfortunately Blackstone and the co-founders of TaskUs were not willing to pony up. Similarly, last week, the shareholders of Core Scientific did not approve the acquisition of the company by the AI infrastructure company CoreWeave. It gets a little tricky with both these companies because they both start out with the word core. This all-stock deal was a big roller coaster right from the start, with the spread on the deal eclipsing 40% just 2 days after it was announced. Which means you can make a 40% profit on the deal if you bought Core Scientific and the deal closed as expected. However, since this was an all-stock deal, you would have had to short the stock of the acquiring company to capture this 40% profit. It was hard to capitalize on this spread because CoreWeave had gone public just a few months before this deal was announced, and it was difficult to short CoreWeave. It was both difficult to borrow CoreWeave stock to short, and even if you could, the borrow rate was extremely high. I saw one hedge fund manager mention a borrow rate of 300%. So capitalizing on that 40% just wasn't possible at that point. And then a few weeks after that, the spread headed in the opposite direction, and the massive positive spread turned into a negative 20% spread. Even if you could short the stock of CoreWeave when the spread was 40%, the risk in all stock deals is that if they fall apart, you could get hit on both ends. Normally, when a deal breaks, the stock of the target drops sharply, as we saw with TaskUs. In an all stock acquisition, the stock of the acquiring company could also go up. So you get hit on both sides of the trade, and this is one of the reasons I tend to focus only on all cash deals. At any rate, this did not happen with Core Scientific deal failure because the deal failed on account of shareholder opposition and not due to regulatory approval or financing reasons. The proxy firm ISS had also recommended voting against this deal. The negative spread on the deal reflected that the failure was widely expected for several weeks.
So, why was the spread on the deal negative in the first place? Why were shareholders so opposed to the deal?
Yeah, CoreWeave had been trying to buy Core Scientific since 2024, but they kept rejecting these offers. After CoreWeave went public earlier this year and the stock ran up significantly, they had new currency through their stock to strike a deal. Core Scientific, which builds data centers and whose primary customer is CoreWeave, was concerned about the volatility of CoreWeave stock because there was a point at which CoreWeave stock did drop quite a bit after a big run up. And because Core Scientific already has CoreWeave locked in as their key customer, shareholders also wanted Core Scientific to continue to benefit from this AI gravy train as it expanded and signed on new additional customers.
That makes sense. I'm curious to see how this continues to unfold for both companies now that a merger will no longer happen.
Yeah, it'll be interesting to see if the shareholders of both TaskUs and Core Scientific were right to vote down those deals and
Mm-hmm.
hold on to them as independent companies. Speaking of roller coasters, we had another one in an existing deal. The acquisition of obesity-focused biotech company Metsera by Pfizer saw Novo Nordisk enter the fray to hijack Pfizer's plan with a higher offer. Novo, the company behind the popular weight loss drug Wegovy and diabetes medicine Ozempic, made a $6 billion offer on October 30th to buy Metsera, disrupting a deal that Pfizer had announced in September for the company. Everything is moving so quickly when it comes to Metsera because the company was founded in 2022, went public in January of this year, and we already have two pharma giants fighting for the company. The Pfizer deal valued Metsera at about $4.9 billion, with shareholders receiving $47.50 per share in cash and up to an additional $22.50 per share in a contingent value right or CVR if certain milestones are met. Novo came in and offered $56.50 per share in cash, which is $9 above Pfizer's offer, plus a contingent value right of up to $21.25 per share, based once again on certain clinical and regulatory milestones. While this higher offer from Novo looks like it is much higher on the cash side and just a touch lower on the CVR side, the deal structure itself is actually highly unusual.
So, what is so unusual about this deal?
Yeah, right after signing the definitive agreement, Novo would pay $56.50 per share to Metsera, which the company would then distribute to shareholders as a dividend within 10 days. While awaiting approval, Novo would hold non-voting preferred shares representing 50% of Metsera. Once shareholders and regulators approve the acquisition, investors will receive the contingent value right. This structure partly appeases investors who might be concerned that the deal could get blocked by regulators. Pfizer came in and criticized the structure, saying Novo designed its bid to circumvent antitrust laws. Why did Novo sweep in with a higher offer? You have to trace this action back to the upheaval at Novo over the course of this year. Last year, Novo Nordisk's market cap of over $500 billion had eclipsed the entire GDP of Denmark, which is where the company is headquartered. Since the stock is down 55% over the last year, it prompted a dramatic shakeup at the company where Novo's top shareholder, the non-profit Novo Nordisk Foundation, took control of the board, criticized former leaders for moving too slowly in the weight loss drug race against main rival Eli Lilly in the US market, And they installed a new CEO, Maziar Mike Dutsar, who promised to build a stronger pipeline of next generation diabetes and obesity drugs as the company prepares for the upcoming patent expiry of semaglutide, the key ingredient in Wegovy and Ozempic. After Metsera received the Novo offer, they were quick to declare it a superior offer and gave Pfizer just 4 business days to make a higher bid before terminating the existing agreement. The short timeline struck me as quite odd, and it clearly rubbed Pfizer the wrong way. Instead of coming back with a higher offer the very next day after the Novo bid, Pfizer decided to go on the offensive. It said Novo had previously made a rejected bid for Metsera and called the new offer reckless and harmful to competition in the obesity drug market. The company has since filed a lawsuit against Novo over the deal, arguing that Novo's offer carries substantial regulatory and executional risk. Pfizer is in a desperate need of a breakthrough in the obesity market. It has faced several setbacks, including early stage experimental drugs that failed to deliver expected results, or they raised major concerns on safety. Its most recent obesity pill project collapsed after a clinical trial patient developed signs of liver damage. This may explain Pfizer's determination to fight for Metsera. The company has filed a lawsuit against both Metsera and its board of directors, claiming Metsera violated its merger agreement by declaring Novo's offer superior. Pfizer has asked the Delaware court for a temporary restraining order to stop Metsera from ending the deal. Along with the lawsuit, Pfizer also announced that the Federal Trade Commission, or the FTC, completed its review and granted early termination under the HSR Act, which was supposed to expire on November 7th.
So yeah, bidding wars are always fascinating, but that's when both companies agreed to play in the bidding war. Pfizer, on the other hand, definitely stepped aside and decided to take the legal route instead. And it's interesting that they're going to the government as well. Isn't there an ongoing government shutdown?
Yeah, that's another unusual part of this completely crazy deal, if you will. Along with the lawsuit, Pfizer also announced that the Federal Trade Commission, or the FTC, completed its review and granted early termination under the HSR Act, where it was supposed to expire on November 7th. This is unusual considering that there is an ongoing government shutdown. The agency hasn't granted an early termination of a review since September 29th, just days before the shutdown began. We discussed this bidding war in even more detail in our latest Merger Arbitrage Mondays article, including the trump card that Pfizer might pull to fight this Novo offer. Metsera closed at $63.04 last Friday after jumping more than 20% when the Novo offer was revealed.
Fascinating situation from start to finish. Now, a good transition between our M&A section and our spinoff section would be a recent M&A deal involving a spinoff. Novartis is acquiring Avidity Biosciences, a biotech company focused on a new class of therapeutics, enabling RNA delivery directly to muscle tissue, and a deal valued at $11 billion. Each shareholder of Avidity will receive $72 per share in cash. Avidity is working on 3 experimental drug candidates aimed at treating rare neuromuscular disorders, including Duchenne muscular dystrophy. These candidates are expected to seek approval by 2026. The acquisition is very much in line with Novartis's 2024 acquisition of Kate Therapeutics, another biotech developing gene therapies for similar neuromuscular diseases.
So this seems like a pretty standard M&A deal. What's interesting about it?
So this deal is actually one of these special situations bonanzas, as I like to call them, where we see multiple event-driven strategies at play, starting out with deals in the works. As back in August of this year, the Financial Times had reported that Novartis had made a takeover approach for Avidity. The stock was trading at around $38 per share before the report came out, and then soon jumped to the mid-$40 per share range. The $72 per share offer still represented a fairly large premium of 46% to the closing share price of Avidity on October 24th, which was about 2 days before the deal was announced. Now, this deal is expected to close in the second half of 2026, and Avidity currently trades at around $69.85, representing a spread of just over 3%. As part of the deal, Avidity will spin off its early-stage precision cardiology programs into a newly created, wholly owned subsidiary. Holders of Avidity common stock will either receive a distribution of 1 share of the SpinCo for every 10 shares of Avidity owned, or receive a pro rata cash distribution of the proceeds received by Avidity prior to closing, if certain SpinCo assets or the SpinCo itself is sold to a third party. Now, the reason for this second clause is because the transfer of these assets triggers a right of first negotiation with an existing collaboration partner of the business. The goal is to streamline Avidity's operations around its core neuromuscular RNA therapeutics portfolio, while preserving and potentially monetizing its cardiology research programs. It's understandable why Novartis doesn't want these assets, considering they're still in the preclinical stage at the moment, as compared to the later stage assets for the neuromuscular disorders.
Yeah, this reminds me a whole lot about Pfizer acquiring Biohaven, where they were only interested in Biohaven's migraines-related drug, and they decided to spin off all the other assets into a company called the new Biohaven. So it ended up with the same name again, just to confuse us. And, I'd calculated a price of about $7 a share for the new Biohaven, and it started trading. I think it had $6 or $7 of cash on the balance sheet when it first started trading. And it did exit shortly after that. So I made some money on the merger arbitrage spread. I made some money on the spinoff that happened. And then Biohaven took off like a rocket all the way up to $60 a share and has come back down to earth now and trades at about $17 per share right now. So that's why when I saw this deal, I was like, oh, wow, I wonder if this is another one of those Biohaven situations where we can pick up something, a few nickels or dimes on the merger arbitrage spread, and maybe even more on the spin-off side.
Perhaps. I think an early signal for the Biohaven performance was that we saw an insider purchase shares in the middle of the merger arb situation, which was strange because the spread on the deal was so tiny. But that's when we learned about the spin-off potential and that buying shares of Biohaven would result in shares of the spin-off, the new Biohaven. And then the insider was entering in that sense, much like we did.
That's right. It was trading, if I remember correctly, at $149. The deal was for $149.50. So he was buying it for that 50-cent spread, which didn't make any sense. To your point, he was buying it because of the spin-off, not the 50-cent spread. So we got to watch for an insider purchase in Avidity, I guess, to see if we should maybe get in or not.
Exactly. And in our insider section, we'll actually talk about a number of other insiders buying in the middle of an active merger once again, and that'll be something else to look out for. But continuing off in our spin-off section, we just wanted to provide a brief update about a company whose spin-offs we've been tracking for months on this podcast, and that is none other than Honeywell. The Solstice Advanced Materials spin-off was completed and began trading on October 30th, and since then has dropped by about 7.5%, while Honeywell, the parent company, remained flat. The spin-off is quite tiny compared to Honeywell, with a market cap of $7.5 billion compared to its parent's massive size of $127.8 billion, which is why even post-spin, the loss of the advanced materials business will not have a significant impact on financial results, and the parent company Honeywell actually expects revenue to grow year over year. Solstice actually has 2 main business segments, refrigerants and applied solutions, as well as electronic and specialty materials. Following the spinoff of Honeywell Aerospace is expected to take place in the second half of 2026. Now, as a result, the RemainCo will be Honeywell's automation operations, both industrial automation and business automation.
Yeah, we wrote about Honeywell as a spotlight idea for our November Special Situations newsletter, but the situation is so complex, we actually broke it down into 2 parts. And next month, we'll focus a whole lot more on the valuation of the RemainCo to see if it makes it an attractive potential opportunity for us. Switching gears to stock buybacks, we wanted to talk about a stock buyback at a gas station operator. So did you know that gas stations make most of their money from the convenience store that's attached to the gas station rather than the actual sales of gas? I remember you and I were talking about that a while ago, and it was quite surprising. That is why I've always felt like EV charging companies like Electrify America and EVgo missed a huge opportunity to capture extra revenue from what is a captive customer that is just waiting for the electric vehicle to charge. We both sat at different EV charging stations and we've seen that there's usually nothing around by either EVgo or other charging companies like Electrify America. In contrast to those electric charging companies, gas station companies have figured out that the convenience store that is attached to the gas station is a good profit center for them. Gas stations operator Murphy USA announced a new $2 billion buyback, representing 26% of the market cap at announcement. They've done this before after announcing a $1 billion buyback in 2021 and then a $1.5 billion buyback in 2023. In both cases, those buybacks represented more than 20% of the company's market cap at announcement. Not only do they make these announcements, but they actually follow through on it and act on it and have retired nearly 25% of their stock in the last 4 years. Robert Murphy was also buying stock on the open market, making this whole situation what we like to call a double dipper situation, where the inside of the company is buying stock as well as the company is buying back its own stock. The company has significantly compressed or low margins. If you look at the gross margin, they're just a little over 10%. But they also have managed to squeeze out nearly 2 or 3% as net margins from those 10% of gross margins. And they appear to be a better managed gas station company compared to HF Sinclair. And I like that that company's ticker symbol is DINO, which is a call out to their green dinosaur logo that you might see on the gas stations. Getting back to Murphy USA, the company is down 25% over the last year as gas prices have come down at the pump due to consistently low oil prices. The spurt of EV sales related to the expiration of the $7,500 federal credit that could also be applied to leases probably had a small impact as well. Both revenue and earnings were down year over year, but that could change if oil prices rebound and EV sales decline because a federal tax credit no longer applies. The stock trades at a forward PE of 15 and a forward 2026 PE of just 14.
Moving from buybacks to the insider section of this podcast, insider activity is always the most interesting when we get to see insider buying within an entire industry. When Silicon Valley Bank collapsed in 2023, we saw a slew of insiders from various regional banks purchase shares as bank stocks began to free fall. Similarly, throughout the course of this year, we've seen high levels of insider purchases at a number of biotech companies as well, as we start to possibly move out of that biotech nuclear winter. So this week, we were quite surprised to see insider buying at not one, but two Class 1 railroads in the United States. Granted, this isn't an industry-wide phenomenon. We're not seeing insider purchases at every single railroad company there is, but there are only 6 Class 1 railroads that operate in the United States, and we saw purchases at 2 of them over the course of the past 2 weeks, CSX and Norfolk Southern. The other thing that jumps out about these purchases is that both companies were involved in some sort of merger news. It's incredibly rare that we see insider purchases in the middle of an active merger, and it's all the more rare to see an insider purchase shares of the target. Norfolk Southern is set to be acquired by Union Pacific in a deal valued at $85 billion, a deal that would have never been possible under the old administration. To be fair, the deal is still waiting regulatory approval and has an expected closing date all the way out in 2027. That could also be due to the fact that the deal is yet to undergo shareholder approval. We discussed the deal in great detail back in episode 29, so I won't hash it out again here, but we were quite surprised to see a director of Norfolk Southern purchase shares when the spread on the deal sits at around 9%.
Always fascinated to see insiders step in the middle of a deal situation and buy stock. What about CSX? Weren't we talking about a potential merger or an acquisition there as well?
Yep, so 10 episodes later in episode 39, we discussed the activist Ancora Holdings getting involved with the railroad operator CSX, encouraging the company to sell itself to either Berkshire Hathaway's Railway, BNSF, or Canadian Pacific Kansas City. So both these railroad operators swiftly quashed any news of a deal, but CSX ended up kicking out its CEO and replacing him with Stephen Angel, the former CEO of the industrial gas and engineering company Lind. Now, during his nearly 5-year tenure as the CEO of Lind, the company's stock price appreciated by 129%. Mr. Angel oversaw the successful integration of Lind and Praxair, creating the world's largest industrial gases and engineering company. Before that, he served as the chairman, president, and CEO of Praxair. Now, Mr. Angel began his career at our favorite company, General Electric, where he spent 22 years in management roles focused on locomotive and rail operations. So one of our first questions was, why is someone from the industrial and gas space coming over? But he has railroad experience from GE. He currently serves as the non-executive chairman of the board for GE Vernova and is on the boards of GE Aerospace and Stoke Space Technologies as well. Mr. Angel made a $2 million purchase of CSX this week, which isn't atypical. We're used to seeing new executives make purchases as soon as they join a business. We read through his employment agreement, though, and saw no terms requiring that he make a purchase in order to receive some other incentive. So this purchase could be indicative of the potential that Mr. Angel sees in the business, especially considering that he left a very successful company he had been with since 2001 to pursue this opportunity instead.
Those insider purchases by new executives are always interesting. I remember in the case of Pinterest, the CEO made a $5 million purchase and then indicated that he was doing that because he would then get maybe another $5 million from the company in the footnotes of the Form 4 filing. But when we saw a similar large purchase by the CEO of Workday, there was nothing in the footnotes of the Form 4 filing, and we had to read through his employment agreement to figure out that yes, there was an incentive where he would get additional shares if he bought some on the open market. So it's a good thing you read through Mr. Angel's employment agreement to make sure there wasn't a clause like this and that he truly was buying these shares on the open market because he believed in the company. Switching gears to activists, it was good to see Starboard getting involved with TripAdvisor, the travel reviews website that perpetually is either the subject of activist involvement or a potential acquisition. The stock has looked quite cheap in the past, and revenue has rebounded strongly coming off of COVID, but both earnings and free cash flow have not kept pace. So nice rebound and high growth in revenue, but unfortunately, the same can't be said for earnings. The key issue is that everyone thinks the site will get disrupted by AI, and I can very much see that that could be the case, as I mostly used AI to plan our last couple of vacations and rarely check TripAdvisor anymore. However, just like Reddit, the user-generated content that is quite unique could be very attractive to AI companies for training their models. The company does have partnerships with OpenAI and Perplexity and also has a content API licensing program, but no large deals like Reddit has managed to strike with some of the AI giants. The company's acquisition of the experiences and tours platform Viator is a bright spot as revenue in that division is still growing double digits. The stock is unfortunately nearly down 16% over the last year and down a whopping 80% over the last 10 years. The company trades at a forward non-GAAP PE of 10.76 and makes a whole lot of sense that an activist needs to get involved to make things change at this company.
Yes, absolutely. Hopefully, Starboard Value is able to turn the company around. We'll end our podcast with a look at C-suite transitions. In May of this year, we wrote an Insider Weekends article about the women's health company Organon, which was spun out from Merck in 2021. As is the case with most spin-offs, the balance sheet was loaded with a massive amount of debt, which currently stands at $8.9 billion. As expected, Organon has been incurring large interest payments every single year. During fiscal 2024, net interest expenses amounted to over $500 million. Despite this, we were initially quite surprised to see that Organon was actually profitable, and in that too, revenues seemed to be growing on an annual basis. However, as we looked at the company, it seemed as if tides were turning. At the time of writing the article, the stock was down over 40% in a single year, and then further dropped by over 30% in the span of a month, largely due to poor financial results and an announcement that came as a huge blow to dividend and income investors. When Q1 2025 earnings were released, the company also announced that they were cutting the quarterly dividend down to just 2 cents per share, representing a yield of less than 1%. Dividend investors were clearly not happy with this change, especially considering that in Organon's Q4 2024 earnings call, management had reiterated their support for maintaining the dividend. We concluded the article by mentioning that Organon looked attractive on a valuation basis, but the declining sales, massive debt balance, and general distrust of management's capital allocation strategy gave us some pause. The business planned to deploy the $200 million saved in prospective dividend payouts to help with the debt balance. But $200 million is such a small portion of the massive debt balance Organon carried on the balance sheet. Now, it looks as if we were right to be cautious, as this week it was announced that Organon CEO Kevin Ali has stepped down following the board's discovery of sales malpractice.
That's unusual. Often they say CEO or the executive is leaving to spend more time with family or something along those lines. What exactly was the sales malpractice that was happening here?
Well, it has to do with their wholesaler practices, and Organon was allegedly encouraging US-based wholesalers to buy more of the company's contraceptive implant, Nexplanon, than they needed over a period of 3 years, so from 2022 to 2025. While the sales involved in this scandal represent less than 1% of the company's consolidated revenue during that period, they did enable Organon to meet guidance and external revenue expectations. As part of this, Organon's head of U.S. commercial and government affairs was also fired following an investigation. The company's CFO, though, will remain in his role as the investigation found no evidence to suggest he was aware of the malpractice. It kind of seems like history is repeating itself because during its time at Merck, Organon was accused of Medicaid fraud related to sales of its antidepressant, as the company was offering the drug to nursing home pharmacy companies at a discounted rate compared to the price offered to federal and state-run Medicaid programs. The company eventually settled in court for $34 million. However, given this new scandal, Organon is once again facing lawsuits from healthcare investors.
It'll be interesting to see if this company can recover from all these blows and get back to growth and potential capital appreciation.
Exactly, all while managing the debt balance.
Indeed, that's what makes it so much more harder.
And with that, we will wrap up episode 43 of the Special Situations Report. As always, what we've covered today is just a brief overview of the special situations landscape. So if you'd like to access a more comprehensive weekly overview of all event-driven activity, go ahead and visit our website, thespecialsituationsreport.com, for daily updates and alerts on the event-driven world, as well as access to tools to help you identify opportunities such as the merger arbitrage tool. Check out insidearbitrage.com.
And if you enjoyed this podcast, please take a moment to like and subscribe on whatever platform you may be listening on, and especially share it with your friends who are interested in special situations. Thank you.
We also wanted to provide a brief reminder that this podcast is for general informational and educational purposes only. The content does not constitute financial, investment, legal, or tax advice. We do not warrant the completeness or accuracy of the content or data provided in this podcast. Nothing discussed in this podcast should be interpreted as a recommendation to buy, sell, or hold any investment or security. Investing involves substantial risks, including the potential loss of principal. You should conduct your own research and due diligence before making any investment decisions. Thank you.